Money. The set of assets in an economy that people regularly use to buy goods and services from other people. Functions of money. 1. Medium of exchange. 2. Unit of account. 3. Store of value. Medium of exchange. Function of money, an item that buyers give to sellers when they want to purchase goods and services. Unit of account. Function of money, the yardstick people use to post prices and record debts. Store of value. Function of money, an item that people can use to transfer purchasing power from the present to the future. Liquidity. The ease with which an asset can be converted into the economy's medium of exchange. Commodity money. Money that takes the form of a commodity with intrinsic value. Gold, cigarettes. What is an example of commodity money? Fiat money. Money without intrinsic value that is used as money because of government decree. Money stock. The amount of money circulating in the economy. Currency. The paper bills and coins in the hands of the public. Demand deposits. Balances in bank accounts that depositors can access on demand by writing a check. M1. Measure of money stock in U.S. includes demand deposits, travelers' checks, other checkable deposits, and currency. M2. Measure of money stock in U.S. includes savings deposits, small-time deposits, money market mutual funds, demand deposits, travelers' checks, and currency. Federal Reserve. The Central Bank of the United States, the agency which regulates the U.S. system of fiat money. Central Bank. An institution designed to oversee the banking system and regulate the quantity of money in the economy. The Chairman Ben Bernanke. The most important member of the Board of Governors of the Fed. Seven. How many governors on the board of the Fed? One, regulate banks and ensure the health of the banking system. 2, control the quantity of money that is made available in the economy. Two jobs of the Fed. Money supply. the quantity of money available in the economy. The setting of the money supply by policymakers in the central bank. The Federal Open Market Committee. Part of the Fed which increases or decreases the number of dollars in the economy. Open market operation. The Fed's primary tool in monetary policy, the purchase and sale of U.S. government bonds. Reserves. Deposits that banks have received but have not loaned out. If at 100%, banks make no impact on money supply. Fractional reserve banking. A banking system in which banks hold only part of deposits as reserves creates money. Reserve ratio. The fraction of deposits that banks hold as reserves. Money multiplier. The amount of money the banking system generates with each dollar of reserves. Money multiplier. Reciprocal of the reserve ratio. Money multiplier. Reserves, total deposits. Bank capital. The resources a bank's owners have put into the institution. Leverage. The use of borrowed money to supplement existing funds for purposes of investment. Leverage ratio. The ratio of the bank's total assets to bank capital. Capital requirement. A government regulation specifying a minimum amount of bank capital. Open market operations. The purchase and sale of U.S. government bonds by the Fed. Discount rate. The interest rate on the loans that the Fed makes to banks. One, open market operations. 2, Fed lending to banks. How the Fed influences the quantity of reserves. Reserve requirements. Regulations on the minimum amount of reserves that banks must hold against deposits. One, reserve requirements. 2, paying interest on reserves. How the Fed influences the reserve ratio. 1. Fed does not choose to control the amount of money that households choose to hold as deposits in banks. 2. Fed does not control the amount that bankers choose to lend. Problems in Fed's control of the money supply. Bank run. when depositors suspect that their bank will go bankrupt and all withdraw their money. Federal Deposit Insurance Corporation. New Deal legislation which has all but eliminated bank runs today. Federal funds rate. The interest rate at which banks make overnight loans to one another.